Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking at simplified trading using boxes. One of the biggest areas where new traders fall down is because they overload their screenshot with too many indicators. Many professional and institutional sized traders will often use price action only to trade, or may supplement their charts with minimal amount of indicators, while many prefer to draw lines in order to calculate areas where price action has consolidated into sideways movement. They can then trade where the breakout will occur. Example A is a 1-hour chart of the USD-JPY pair with only price action in the form of Japanese candlesticks, blue for bullish or up and red for bearish or down. On the face of it, although there seems to be a general bias to the downside, it would be fairly difficult to pinpoint where to enter as the hours roll by. In order to confirm consolidation or sideways trading, a simple rule applies. Price action must have touched at least 2 areas of resistance and at least 2 areas of support. Traders will confirm this on charts by simply adding a couple of horizontal lines once they have identified this consolidation as per the price action. They will then make the necessary trading decision based on the information they see. Now let's look at example B, where we read our charts from left to right because they always tell us a story. And at the beginning of the session in question, we can see that at position A, we have confined an area of resistance and support, where we can see that both lines have been touched by price action on at least 2 occasions. In this example, we have closed off the end of the parallel lines, and thus we can now identify this area as a box. This is where we can see that price action punches through the support area and that traders will have gone short here. If we move on during the course of the trading session, we can identify another 2 boxes in example C, firstly at position B and then at position C. We both have a minimum requirement of 2 touches of the support and resistance lines. In example D, we can drill down a little bit more and identify this pair as consolidating at position A and then taking a move lower, then consolidating again at position B before taking another step lower and then consolidating again at position C. This is where traders will have picked up the bias to the downside and traded accordingly at breaks in the support lines. Finally, in example E, let's take a closer look at the false breakout to the downside at position X. There will always be times when traders are wondering if the market has stopped or bottomed out, and this will cause breakouts from our boxes to be quickly reversed. And this happens at position X, where we see a break of the support line and where the selling action has run out of steam and the buyers have come in and reversed price action back up to box C. However, the move lower still produced 18 pips to the downside on this occasion, which is not an unreasonable amount. Most importantly, price action does not continue up to the area of resistance and begins to stall at position Y before fading back to the support line, and where the second breach at position Z is much more enhanced and produces 45 pips to the downside before price action looks to form the basis of another consolidation period. The total move lower just by using the simplified box trading produced a total of 144 pips. Do not underestimate the importance of simplicity and consistency in Forex. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.